27th February 2023, Monday, MAO with Cal once again. Now, both Credit Suisse and Goldman Sachs are all affected, and do you know who's affecting them? Yes, the consumers. Yes, indeed. Why? Because they have been lending, they have been giving, and the problem is if interest rate keep on climbing and consumer can't pay, these banks will be in trouble. Well, let's go into them right now. So once again, do your risk assessment, and thank you AIMS for the kind sponsorship. Now, before we go into all the detail for today, now 5 lucky winners, okay? 5 lucky winners. You guys have won Stanley, Benedict twice, JL, and Steven. Alright, you guys have been contacted by us through YouTube channel. Please contact us. The lunch will be on Wednesday. Alright, so take note of this, okay? Alright, thank you. Now, people ask, the thing is this, can TWB system be helpful? Well, let's take a look over here. This is what happened today. This morning, the Seng gap up, and once it crossed and the color changed from red to yellow, it will be a buy immediately. And of course, for us, we went in to go long into the market. As you can see, we bought the market all the way up. And once it hit about this point, KTR plus 3, that was where we actually booked our profit. Not too bad, right? Pretty good profit, right? Okay. And the thing is this, when the market came back down here itself, right? By right, yellow turns to red, breaks below our pivot, it will be a sell, and we take a sell position, and again, voila, we make some good money. So all this tells you that the TWB system is pretty helpful. So if you guys want to know more in detail, PM us for more details. All right, okay, cheers. Now let's recap what happened last night, okay, or Friday. Well, the Dow Jones dropped by 336 points, Nasdaq 210, S&P down 42 points. Tesla down by 2.57%, so it's down back below $200. And you can see across the board they are selling. Why? Because the market now really believe that there could be more interest rate coming in, and the 6% thingy is likely happening. Main reason was I was pretty spot on my view on the PCE data. Alright, remember everyone was looking at about 0.4%, but I say that nope, we'll see 0.5 to 0.6. So this PCE data is a preferred inflation gauge by the Federal Reserve, which they claim they now like it so much. And now this particular indicator is backfiring them. So the thing is this, because of that right now, company shares got very frightened. They believe that the Federal Reserve will hike rates more and there'll be no cuts this year. So now the market panicked, okay? Now Boeing share actually slipped 4% after a temporary halt delivery of 787 Dreamliners over a fuel issue. And of course, Microsoft share and Home Depot also went down respectively. So this is the answer here. The numbers were 0.6% and it's 4.7% from the prior year. And this is actually much higher than the Federal Reserve 2%, right? And if you actually remember this, I was saying on Thursday or Friday in the afternoon, I was saying that my view that we will see the PCE data hitting 0.5 to 0.6. So it's pretty spot on. And for those who have profited with me, congratulations to all of you once again. Now, because of that, right, you can see now the short selling has started to come in again. This is from Morgan Stanley Prime Brokerage, and you can see that the short selling exposure is actually increasing right now, and the LS ratio itself is at the low end. So this is not a good sign, and things can go pretty ugly. And why I say about Goldman Sachs, because Goldman Sachs, remember recently they came out and they missed their earnings with Morgan Stanley, and the main reason is because they lost $3 billion on consumer lending push. Now what is that? So basically, right, it's actually the money that is including closed and open credit extension to individuals for household, family, and other personal expenditure, including credit cards, auto loans, and student loan. So actually, it's just loans to these things, and hopefully they pay. But when consumer can't pay because of the high inflation, unemployment potentially coming in, so all these actually caused this so-called investment bank to be in trouble. You can see that this is something that happened in January, and I suspect that this will go higher, because if more and more people can't pay or more delinquency happening, right, definitely this will become a problem. Now at the moment now, of course, you can see back in January, the share price came down from 370 back to 338. Then of course, Goldman Sachs saw the rally all the way to a new high for the year, but now it got pushed back again. So if you'd ask me, in my opinion, if Goldman Sachs now can't stay above the previous high, which is here, and then there is a very strong support around 355 area, this level really must hold. If Goldman Sachs fail to stay above 355, then the selling will bring it back down to 338, and that is where near to the support of the year itself. Now, of course, at the moment, we haven't seen the real full-blown of the US in recession yet, so maybe now it's still okay. But of course, as an investor or trader, we always sell before the news or we buy before the movement. All right. So in this case itself, right, I'm pretty confident that Goldman Sachs may see further downside because credit card accounts in US has increased to 555 million in the third quarter of 2022. That is much higher in the second quarter of 2022, right? So this actually tells you that the people are actually borrowing and borrowing and borrowing. But don't forget, the interest rate environment is also going up at the same time. So if let's say employment is to go down instead, this is going to be a very big problem. And who's to suffer, guys? It's not only the individuals, it will be the banks, because the banks are the one actually lending the money to these people. And according from this car dealer, all right, in the US, he said that the car valuation is now plummeting. All right, some cars have declined over more than 30% in a single year itself. Now, this is not a good sign at all. And of course, these big loans are now all underwater, and they owe the banks more than the car that is worth. And the banks knows it. So this is again a repertoire of what happened back in 2008 crisis, whereby things happen. And of course, if this bank know that and they can help it, then this is going to get very, very bad. So 9 of our lending partners have started this waiving of open auto stipulation for consumer. So what the hell does it mean? Okay, he actually explained that meaning is that trying to lower cost for the consumer. If not, it's right, this whole thing will go in a very, very bad shape. So that's why Donald Trump actually came in and said, you know what, that is very fortunate that, you know, we are just so near to a World War III according to Donald Trump because of what's carrying out between China, US, Russia and stuff. Now, why I talk about this? Because if there's going to be anything going to happen in these few countries, right, the repercussion is going to be global pullback. And if that really happened, I cannot imagine what will happen to these people who lend money to this consumer, because the consumer will take this advantage. They know what, there's a war going on. Why should we pay? Now that will get into a very terrible state. Let's see what Donald Trump has to say here. It's pretty cool.
3 has never been closer than it is right now. We need to clean house of all of the warmongers and America last globalists and the deep state, the Pentagon, the State Department, and the national security industrial complex. One of the reasons I was the only president in generations who didn't start a war is that I was the only president who rejected the catastrophic advice of many of Washington's generals, bureaucrats, and the so-called diplomats who only know how to get us into conflict, but they don't know how to get us out. For decades, we've had the very same people, such as Victoria Nuland and many others just like her, obsessed with pushing Ukraine toward NATO, not to mention the State Department support for uprisings in Ukraine. These people have been seeking confrontation for a long time, much like the case in Iraq and other parts of the world, and now we're teetering on the brink of World War III.
Wow, what a word, man. But undeniable, if really US really push agenda in Ukraine, and if Russia continue, and if China technically, in a way, help them, this is going to get very, very, very ugly. So undeniable, if this thing happen, guys, the stock market would definitely take a tumble and things will get very scary. So now you can see the Federal Reserve is right back in 2007. They already say we'll see a soft landing. There will be a soft landing for US economy, and it's on track for soft landing. Remember? Yeah, from Reuters, New York Times, right? All these mainstream media. But remember, that was in February 2007, and we all know what happened then. After that, in October, the whole thing just went all haywire, and the economy just collapsed. So now today, we're in February again. As you can see, very incredible. We are saying the same thing again. They are telling us right now is soft landing coming in. They're optimistic. They can drive inflation down. It's all under control. But BS here, guys. We all know that they say it's inflation. The inflation is just transitory. But what happened? Things didn't go as well. So guys, interesting. If things go in cycle, then February is now today in 2023. And that was something they say also in February in 2007. Guys, things can get very, very out of hand. So now take a look at this chart here. So this is very crazy, guys. Take a look. Now this is the Wilshire 5000, and you can see there's already a pullback over here, and this tells you there's some weakness in the market. But it's because the Federal Reserve is increasing interest rate at a very fast speed. It's one of the fastest, steepest run for 11 to 12 months. And at the same time, we know that now the yield is inverting, and this inversion itself is going back all the way the same like magnitude in 1980s, and we all know that what happened with Paul Volcker coming in to really stamp authority by hitting interest rate all the way to 20%. Now, I don't think Powell has the tenacity to do that, but if he is forced and if inflation get really out of hand, 6% is the minimum, guys. To me, it's alright at the moment. Not many people saying this, but for me, I'll be upfront here. I believe that we'll see a 6% Fed fund rate at least by August, and if things still doesn't do well, we can even see a 7%. Now, if 7% do come, you can imagine that what is going to be happening. Things will go so crazy, the stock market will pull. So that's why I believe that, guys, this 6% is minimum. If things go crazy, we can see even 7%. So this is something that you need to be very careful because things can get very ugly. And of course, the other company that I'm looking at as a problem, I've been calling for sell on this company for the longest of time. You can check my archives. I've been calling for Credit Suisse for selling. Now, we saw back then in 2022, right, there is a very historic outflow of funds in this fourth quarter in 2022. And why is that so? Because people know that the earnings will be terrible. So apparently, remember that in this December itself, right, when people ask the CEO, why is there such a big outflow, right? The chairman actually tells Bloomberg that the bank basically stopped outflow already and things are stopping, things will be good, no need to worry, all is well. Remember that was in last year itself. But you can see from here, guys, this is where the interview happened. Okay, let me just clear my screen a little bit. There's a bit of a delay on my drawing. Now, this is the date, 5th of September. That was where the stock price recovered from $3, recovered back to about $3.60 within 3 days. And then after that, the chairman said things are okay, but the market didn't buy on it. In fact, the market slowed down. Then they created a double bottom. And of course, back then, we saw a recovery in the US stock market. So Credit Suisse recovered together, but you notice that it only recovered to where it started. And then after that as well, when the earnings came out right, oh my God, it was so bad that the share price plunged down and went for a new low for the year itself. All right. So remember, I told you Credit Suisse will break below $3, and it really happened. The thing is this can go even lower. Why? Because remember this, after that as well, right, we all saw the quarterly loss was $3.9 billion, and it was largely driven because of the decline in the real estate evaluations. And of course, this thing will go down lower, in fact. And of course, they also say that they don't think that they need to raise the extra money. Their capital position is now very strong. But remember this, back then in Lehman Brothers, they also say the same thing, and then Lehman Brothers collapsed. Okay, so what do you think, guys? This is not going to be fun. So now the thing is this, people who are very into it itself start to dig on them, and they realize that, look, if you're telling me the truth, then there is a 85% outflow back last year. So if that is the case itself, right, then that means that there is a very high chance that there will be a possible further downside. And in fact, itself, right, Credit Suisse last year has basically come out they came out with this this share writing, and then they say that for share to be subscribed, and of course they set the price at the 32% of the price back then. Right. So think about this right now. If the price is now dropped below 20% from that point to 25%, there will be no more benefit. And if that's the case itself, right, the investors will not convert. They will rather take a loss. And if that happens, you can imagine what will happen to the counter itself. So this is very scary, guys. They really need to maintain it above this price, which is 252 itself. Okay. If anything goes lower than that, guys, this is going to break very badly for Credit Suisse. So that's why now there's a lot of coverage of Credit Suisse, and they say that right now, with the bank actually posted $1.5 billion in Q4 losses, and they see substantial losses in 2023, who the hell will be daring to buy this counter? This is not going to be good. And of course now, more people is investigating that the command from the chairman back then in December, is there any form of truth? Is there any form of misleading? And if let's say someone really found it, if the authorities think that, okay, the chairman was misleading the investors to buy into the shares, I tell you, this can really drive Credit Suisse share. If I look at it, Credit Suisse share can really drive down to $2.50. And when that happens, it will send a wave of problem across. Okay, this is not going to be a joking matter, guys, because now Credit Suisse has cut their property fund payout withdrawal. Okay, because why it's mounting. Apparently now the Credit Suisse Real Estate Fund International NAV to drop as much as 10%. And with investors with 13.3% are trying to redeem it right now, okay? So think about this. If things are going well as they say, then why are people withdrawing? Because they know that there's some problem going on. And this is exactly the prelude of what happened to Lehman Brothers when it was coming down, and everybody would say that no way, no way, no way. But things just really happen. So would that be a bank run? I don't know, guys. I don't think so, but this is not going to be fun. I think it gets very scary, and traders, you should be very, very careful. Things can really get out of hand, yeah? So pay attention to more of my MAOs to know more to do, right? Alright, with that aside, right, we go to the technical side and see what we can do for today. This is Cal signing off.